Okay, let's jump right into this explainer. Today, we're investigating the absolutely massive recent stock run-up of one of North America's oldest financial institutions, the Bank of Montreal. If you've been watching the financial sector at all lately, you know BMO has been making some serious waves. But we need to figure out, is this momentum actually sustainable? Are we looking at an unstoppable juggernaut or just an overvalued bubble?
Just a quick heads up before we really get going. Everything we're covering today is strictly for educational and informational purposes. Our analysis is based on publicly available data as of August 2026, and it's definitely not financial advice. Past performance doesn't guarantee future results, so always remember to do your own research. Here's how we're going to break this down today. First, we'll meet the BMO juggernaut, dig into their record-breaking numbers, and unpack their strategic growth blueprint. Then, we'll weigh the bull case directly against the bear case before finally arriving at our final verdict.
Part 1. Meet the BMO juggernaut.
We really have to start by establishing exactly what Bank of Montreal is today. Because, listen, we aren't just talking about some dusty 200-year-old bank coasting on its reputation. BMO is an absolute titan. Right now, they're the 8th largest bank in North America, commanding an astonishing $1.5 trillion in assets as of April 2026. They're actively serving over 13 million clients all over the globe, covering personal, commercial, wealth management, and investment banking. It's a massively diversified operation.
And here's where things get really interesting. Even though it's a Canadian institution by name and heritage, a full 40% of their earnings actually come from the United States. That's not just a fun piece of trivia. It gives them a huge cross-border advantage and really helps insulate them if there's a regional economic slowdown up north.
Part 2. Record-breaking by the numbers.
With that foundation in place, let's look at the sizzle. These are the numbers that have everyone buzzing right now. Just look at the staggering outperformance. With shares trading around $174 as of late August 2026, BMO has delivered a massive 56.25% one-year return. I mean, they're absolutely crushing the broader Canadian market. To put that into perspective for you, while the S&P/TSX composite grew by a very respectable 30% over the last year, BMO nearly doubled that pace. In the catalyst for all this crazy momentum, the real jaw-dropper came on May 27, 2026, when BMO reported a record adjusted net income of 2.7 billion Canadian dollars for their fiscal second quarter. That is a 34% increase year over year. Let's break that down a bit more, because it builds a pretty overwhelming picture of success. They posted a massive 40% jump in adjusted earnings per share, hitting $3.67. Their revenue climbed 10% to over $9.5 billion. And this is crucial. Provisions for credit losses actually fell to $739 million. Management was so confident in these numbers that they went ahead and raised their quarterly dividend by 5%. It now yields a solid 2.8%, but keeps a very safe 48% payout ratio, which makes it a super attractive play for income investors.
Part 3. The strategic growth blueprint.
So how exactly does a legacy bank pull off these hyper-growth numbers? We have to look under the hood at the engine driving their strategy. It's not just basic banking anymore. We're talking about highly calculated strategic maneuvers. Take the mechanics of the Moneris sale, announced in August 2026. BMO and RBC sold their jointly owned payment processor for roughly $2 billion. BMO walks away with their $1 billion share, quietly booking a massive $600 million after-tax gain. This brilliant move boosts their capital ratio by 15 basis points. But here's the real genius part. They kept their valuable referral relationships intact. They basically cashed in without giving up the commercial benefits.
But it's not just about one-off windfalls. The bank is aggressively cementing its future by integrating AI across the board. They were actually just named Euromoney's best retail bank in Canada for 2026, thanks in large part to their next best offer AI technology. They're launching innovative new products like 3-by leveraged U.S. corporate bond ETNs, and they've set a highly ambitious target of hitting over 15% return on equity by 2028. This is a legacy bank playing serious offense.
Part 4. The bull case.
All right, let's unpack this intense market clash, starting in partially with the bull case. Why do so many investors think this massive run is just getting started? Well, bulls point straight to BMO's highly lucrative U.S. market expansion. That 40% earnings exposure perfectly positions them to ride the wave of U.S. economic strength. Plus, the momentum is undeniably robust. EPS is projected to surge almost 20% to $14.55 in fiscal year 2026.
Add in a super safe dividend growing at nearly 6% annually and some massive confidence votes from institutions. I mean, Scotiabank recently dropped $920 million on shares, and heavyweights like BlackRock and Berkshire Hathaway are holding massive positions.
Part 5. The bear case. But hey, what goes up must be scrutinized, right? The bear case presents some really heavy, data-backed counter-arguments to all this unrelentless optimism. We are seeing a direct contradiction in the market right now. On one side, individual analysts are out there hiking BMO price targets all the way up to 295 Canadian dollars. But on the exact same day, we're seeing sector-wide warnings flagging that a 34% year-to-date banking rally has pushed valuation multiples dangerously above historical norms.
Just look at the absolute tug of war happening with valuation models right now. The GF value metric is practically screaming that BMO is nearly 45% overvalued at current prices. Discounted cash flow models back that up, suggesting it's about 37% overvalued. But then you look at other models like Simply Wall Suit, which suggest it might actually still be slightly undervalued. When the models disagree this violently, your risk as an investor is inherently elevated.
The bears also love to point out that despite all the hype, the consensus rating from 15 polled analysts is basically just a cautious hold. You've even got firms like Barclays throwing a sell rating on it, citing those full valuations. Then there's the looming macro risk. With the Bank of Canada holding rates at 2.25%, we could see a real squeeze on net interest margins. When banks earn less on the spread of every dollar they lend out, their profits compress. Combine all of that with some moderate insider selling over the last 3 months, and the bears argue the top might already be in.
Part 6. The final verdict.
So when you weigh all this incredible momentum against those very real valuation concerns, you're left with a fascinating dichotomy. On one hand, you have a fundamentally strong, highly profitable bank executing massive strategic moves, growing EPS by 40% and drawing huge institutional capital. But on the other hand, that bullish reality is directly fighting against historically high sector valuations, a mixed analyst sentiment, and some undeniable macro uncertainty. BMO's 200-year track record and modern AI investments definitely showcase brilliant long-term management. But the reality of a 56% one-year run means a lot of that good news is probably already priced in. It really boils down to this. Investors buying at current levels are paying a premium, and that premium needs to be justified by absolutely flawless execution moving forward. Any slight disappointment could trigger a pretty sharp pullback. So as we wrap up this deep dive, I'm passing the mic to you. Given the soaring, record-breaking profits mashed up against these incredibly stretched valuations, which side of the fence are you on? Are you bullish or bearish on Bank of Montreal right now? Think about it, run the numbers for yourself, and as always, keep learning. Thank you for joining me on this explainer.